Good afternoon. It is your girl Shirley. You're tuning in live now with Mortgage Money with Shirley. It's episode 12, y'all. Episode 12. Why do lenders say no? You might ask yourself that if you fall into that category. But again, you're on now. I am Shirley Nichols, your host for today with Mortgage Money with Shirley. We're going to be talking all things mortgages, and I'm right here live in the Morris Media Studios here in Los Angeles. So if you have a question, comment, or concern, feel free. You can go ahead and call the studios right now, and we'll answer your call, answer your question. And then if you don't feel comfortable calling in at area code 323 815-4204. Again, that's area code 323-815-4204. You can call in right now to the studios. But again, like I said, if you don't want to call in, that's fine. You can direct message me or getting in my inbox is fine as well. And I'll try to respond to all of your questions and concerns, okay? We are live in the studios and on my Facebook page, my personal page, Shirley Nichols, and my business page, Clear Sky Mortgage and Realty, okay? So those two Facebook pages, you can find me, or on the YouTube channel, Mortgage Money with Shirley. So I hope that everyone is doing well on this bright and sunny Wednesday. Well, it is a little bright and sunny here in Los Angeles, but it is Wednesday, September 29th, and we're going to jump into episode 12, Mortgage Money with Shirley. Why do lenders say no? Right? Okay. So when you call us on the phone, us meaning us mortgage brokers, when you call us on the phone and we go through the whole credit application, your name, address, social security number, your date of birth, where you're working, how much you're making, your savings, your checking account. We're going to go through all of those steps, right? That's the very first thing, matter of fact. And I should kind of go back a little bit because I think, all too often, even in this day, I've been a mortgage broker in mortgage lending for over 28 years. I know I look 12. No, okay. But I've been a mortgage broker in the mortgage lending industry, I should say, for over 28 years, right? So I pretty much know quite a bit of information. And that's why I'm doing these podcasts, to hopefully bring to you some education, some information, some tidbits that you can use in your house purchasing or refinancing journey, right? Mortgages and houses are probably one of the biggest assets that you'll come across or purchase or have or own in your lifetime, right? And so I hope that some of these tidbits kind of help you ease the journey. So when you're getting ready to purchase a home or refinance a property or start your investment portfolio, you're going to call your mortgage broker. That's me. And we're going to go through what's called a credit application to try to get you pre-approved or approved. Excuse me. And once we get you approved or not approved is what we're going to be talking about today. What are the steps and the actions that you can take that hopefully try to circumvent what has happened, okay? So initially, you're going to make the phone call. Hello, hi, I'm Shirley. Hi, Jane. You're interested in purchasing or refinancing your property. Let's get started with the basics. And the basics are just what I said. Name, address, date of birth, social security number, where you're working, how much you're making, what's in the checking or savings account, what's in the 401k account. And then I'm going to pull your credit. I'm going to pull a tri-merge. It's all three credit reports. I'm going to pull them as a one report, and we're going to look at all the information that's on there. And then I'm going to compile a whole stack of documents from you. I'm going to get your pay stubs, W-2s, bank statements, tax returns, your driver's license, okay? I'm going to get a lot of information from you. I'm going to put it all together, and I'm going to send it right over to the underwriter. I'm not an underwriter. So what the differences are in the position, I'm a mortgage broker. I'm a loan officer, a loan originator, right? And as a loan originator, loan officer, mortgage broker, all the same thing, just different titles to try to sound fancy, but the same position basically, okay? The same type of duties. So what my job is to do is to look at your file, to look at all those documents I compiled, to look at your credit report, put it all together, add up how much income you're making, look at the savings in the checking account and the retirement funds. I'm going to look at all of that stuff, right? And I'm going to compile a file. And hopefully within this file, maybe there's a letter of explanation about something. Maybe there's a submission sheet that has a bunch of information on there. I'm going to put it all together to make it look nice and neat and hand it to the underwriter, okay? And not necessarily hand it, but I'm going to scan it in and then send it on to the underwriter. Underwriter is going to look at it. Okay. And now there's a couple more steps that happen before the underwriter gets it. And it's mainly your compliance checks. Okay. Sometimes clients will say, well, Shirley, I submitted my file to you on Monday and you didn't give me an answer on Monday night. And that's a little unrealistic at times. But believe it or not, we do have a lender that will actually let us know if you're approved or not approved for conventional loans only. We do have a lender that is actually doing approvals or non-approvals within the hour of us submitting them. Yeah, so I'll talk about that too. So it doesn't have to be a wait unless you've got one of those files that, I don't know, you've got 10 companies you own and 10 K1s and 10 sets of business returns. You know, sometimes we get files that are really, really top heavy and convoluted, right? And those are the files that will take a little longer than an hour to get approved or not. But we do have a lender that I work hand in hand with, and that is excellent, that will get you an approval or not an approval within an hour. Within the hour's time, you will know what you're qualified for. How's that sound? I mean, it is so fantastic. They just came out with it today. It's launching today. It's going full steam ahead. We submit a file at 12 o'clock noon. We're going to have an answer back at 1 o'clock. I mean, that's how quick they're moving. And it's fantastic. Like I said, they just launched it today, and I can't wait to try it out. Can't wait to use it. So we'll be getting into that. But back to what I was saying, right? Without this new launch, I'll submit a file on Monday, right? And my client will say, well, I didn't get an answer Monday night. No, but you'll probably get an answer on Tuesday. Because what's happening between the time I submit on Monday till Tuesday's answer is there's compliance checks, right? There is a check to make sure everything's included in your file, that I picked up the pay stub, the W-2. All that stuff has to get submitted along with you signing disclosures. Now, one thing I still get asked in this day is that those preliminary disclosures, Shirley, are they binding or can I change my mind? Sure, you can always change your mind, right? Even up until the day you sign your loan. If for some reason, I don't really like this, I don't like the way it's going, I don't want to do it, you can cancel, okay? So all these things that happen up until the point that you're funded, you can cancel. Believe it or not, you can, okay? So I think that's another thing that's scaring a couple of borrowers and first-time homeowners is, oh my gosh, I got into this contract and now I don't even want to buy the house. What do I do? Well, heaven forbids you don't have those jitters, but if you do, right, talk to your realtor, talk to your real estate agent, figure out if you can get out of the contract. You know, I'm not even going to discuss this any further because hopefully that is not you and that doesn't happen, but anything can happen. Okay, so let's go back. You submit your file, underwriter gets it, right? Underwriter is looking at all the income that I put in the system, right? And I've looked at your W-2s, I've looked at your pay stubs, and I said, oh, here's what you're making. This is what we calculated out, and I put it in the system. The underwriter's going to pick up that file, look at it through the system, and they're going to go, oh, yeah, this does make sense. You get an approval. Now let's talk about today's topic, episode 12, why do lenders say no, right? Now, there are some occasions that lenders might say your loan is suspended. We don't really like to say, oh, you're declined. Oh my gosh. We don't really like to say that. So we might use words like your loan is suspended, or we might have to counter you, right? It's not the end of the world. The thing about getting a suspense or a no, or we've countered you to something else, you got to figure out why this has happened, okay? And sometimes it can be a quick or an easy fix. Sometimes it's something as a matter of, well, we don't know if your job is really hourly or is it salary or is it every 2 weeks or once a month. Sometimes underwriters really don't know, okay? But it's your job as the loan originator, loan officer, mortgage broker to get a verification of employment. So make sure when you're doing these applications, guys, that you are giving good numbers for your employment verification, because we will call them. And sometimes there are employees that only use what's called the work number. The work number just gives the very bare minimum information about your occupation, right? And that's why some underwriters will say, oh, well, we're going to suspend your file because there's not enough income here. But what you'll find is if you take a step further and you have a good loan originator, right? A great mortgage broker, they're going to call the underwriter back. They're going to say, okay, let's look at this work employment verification. Let's look at this. Okay, so right here, it gives you just a dollar amount, a base salary. But this client also gets bonuses. They get commissions. They get overtime. And sometimes it's just a matter of if you're getting overtime. Here's a quick tidbit. If you're getting overtime, lenders and underwriters will use your overtime as long as you can prove 2-year consistency of that overtime. Same thing with bonuses, okay? So if you're in that position where, oh no, they're only going to count my salary, but I work all this overtime, they will count it. They will use it as long as you can prove 2 years of history of working overtime income, overtime hours. And that's the thing about work number. The work number, and I mentioned the work number because this happens over and over and over. As more firms are having employees work from home or work remotely, they're relying on technology to utilize information for employment verification. So one of the softwares that a lot of companies are starting to use more often is the work number. It's just the application software for employment information. And as you use that, as underwriters will use this software, they're only getting the bare minimum information. Like I said, they're only getting that base salary. They're not getting the overtime, the commissions that are happening and broken down. Most of the time, they're not going to get that. They're going to get the bare ball minimum. Now, every now and again, you'll see maybe the employer has updated the work app and they will put in commissions, bonuses, and overtime, right? So every now and again, you might get that. But if you don't, it is up to a great loan officer to dig through that and get the information to the underwriter that says, hey, look, in 2019 and 2020, there's overtime, there's bonuses, there's commission. And then they'll average all that in, and bada boom, bada bing, that suspended file now is an approved file because you've proven more income, right? So there are ways to work around these suspense. And I know, hey, I'm a homeowner too. I'm a client. I know we can get frustrated and we can think, oh my gosh, this lender has told me, no, just forget it. I won't get a house. I won't buy this house. I won't refinance this house. Just forget it. But you have to get to the reason why they suspended it. And like I said, with a great loan officer, they'll get to the reason for you. And then they'll get that loan to an approved status if it can be done. So don't give up on this, oh my gosh, I don't have enough income. Now, that's sometimes the reason for a suspended or a not approved file because there's an income challenge, right? Another thing about this income business, I have a client that, oh my gosh, during the pandemic, they decided, well, since I'm working from home, I'll go ahead and get my leg operated on. I've been having this aching knee, and I just want to go ahead and get the knee surgery done. So I'll go and get my knee surgery, and I'll use my disability, right? Now, they're using this disability for 6 months. They've gone through AFLAC or whomever, and they decided to get this disability income instead of their wage earning income, right? So this disability income, believe it or not, it can still be counted towards income, temporary income, right? Because there's going to be a letter we're going to obtain from your employer that's going to say something like, John Doe will be back to work October 1. So with these disability checks, and basically all they're doing is pretty much just verifying that you were getting income, right? And that there's not a huge employment gap, okay? So you're still employed, right? But you took 6 months off for disability purposes, right? And you received disability income. So the underwriter can see there's still income flowing through, maybe not from the employer, but there is a disability policy that's in place. And this disability insurance company has provided these checks and verification. And you also have a doctor's note. Remember those good old-fashioned doctor notes? Okay, so you've got a doctor's note, you've got your disability checks, and you've got a letter from your employer that says, oh yeah, John Doe will be back to work October 1, okay? So don't think, once again, I've applied for this refinance, this purchase, and they suspended my loan because now I'm disabled. don't think, once again, that you can't get that suspense file into an approval status based off of you've got all these documents lined up that I just talked about. Okay, so does that make sense, right? You may have a suspended file, but get a great loan officer and they're going to ask the right questions. They're going to approve what may be suspended and they're going to get it worked out, right? And same thing with self-employed, okay? Self-employed income. We talk about this from time to time. That business for self-income. It's draining. It's convoluted. It's top-heavy, but it can be done with the right documentation, okay? Working with the client, again, and I bring to you all these scenarios. When I'm talking about these scenarios, these are real-life scenarios that still go on in the 2021. They do. And they'll continue to go on and on and on. Because as I'm bringing you these experiences, guidelines, mortgage lending guidelines are changing all the time. They're evolving and they're getting better, just like those interest rates. Interest rates, we could go on and talk about those too, but we'll stick to the topic of why lenders say no. Okay, so we talked about the income factor. How are they averaging out your income with commissions, bonuses, and overtime hours? We've talked about the disability, being on disability, and oh my gosh, what if I can't qualify? But you probably could if you have all these documents lined up. But let's talk about the self-employed client, right? The self-employed client. So here we have both 1040s, okay? Those are your regular individual federal tax documents, tax returns, right? We have your 1040s, and then we also have either a partnership or sole proprietorship or business corporate returns. We have separate returns for those. Now, most of the time, they're going to mix those together, right? They're going to average out these incomes and they're going to mix them together because what's on your self-employed business returns typically spills over to your 1040s, okay? Or unless you're doing a 1040 with the Schedule C for self-employment income basis, however you want to structure it, but be careful. Again, working with the client, business returns, they carry a huge loss, right? Whatever their job and occupation is for self-employment, they carry a loss, which is standard. That's normal. Most self-employed people are going to carry losses over and over. Each year after year, they're going to carry them over. Not a problem, nothing wrong with it. Hey, I don't want to pay Uncle Sam more than what you want to pay them. So you carry over these losses, right? But in the mortgage lending world, if you carry over these losses, then they're going to fall back on your income and what you can qualify for. So one thing that you may be able to do, here's a little tidbit, get in close. When you're filing your business returns and you're going to file and obtain a K1 schedule, K1 to show you how much of this business do you own, right? On that K1, in the lending world, if you own 25% or less, then that loss is not counted against you, right? How's that sound? If you're carrying a $100,000 loss from your business, and over here on your regular schedule, or your regular 1040s, you're also filing W-2 wages of $100,000. Most of the time, that $100,000 that you filed as a wage earner, W-2, on your 1040, it's $100,000 over here, but it's a $100,000 loss on your business returns. The underwriter cancels them out and says, "Black, you make no money." That's because you've got this K1. The K1 form is like a W-2, right? It shows you, and I'm saying that because of the short form that it's on, okay? It doesn't really correlate, but you've got a short form W-2 and you got a short form K1. The short form K1 basically just tells you how much ownership you have in a business. And what in the mortgage world, if you have less than 25%, so I'm talking 24.99. If you have less than 25% of ownership on that K1, then that loss doesn't spill over to your regular wage earner W-2. So then, bada boom, bada bing, now you qualify, right? So those are just some tidbits. Like I said, sometimes that suspended file or that unapproved file, sometimes it's fixable. But you got to get to the root of the problem, okay? So that's the income portion with self-employed, disability, and how you're paid monthly, hourly, salary, right? That's that portion of it. But now let's scoot over to the credit side of it, right? So you have the tri-merge, right? We talked about how I'm going to pull your 3 credit reports, and we're going to get a tri-merge. And that tri-merge says you've got a credit score of 700, a 650, and a 600, right? Because you're going to get 3 different bureaus with 3 different FICO scores. We're going to take that middle score. I've talked about this before on previous podcasts. We're going to take that middle score. So the middle score is a 650, right? But you want a jumbo size loan with cash out, it's a duplex, and you want a high loan to value, right? So the 650 with the A paper lender, not going to cut it. They're going to say you need a 680, right? In some cases. Now, there are some lenders, please be clear, there are some lenders that will do the scenario that I just said. Jumbo size, duplex, multi-unit, cash out, high loan to value. There are plenty of lenders out there that will do that with a 600 credit score, a 620, a 610. There are some out there that will do that, right? But let's talk about the A paper lender that's going to give you top-notch interest rates, right? Give you the interest rate for a little bit of money. We're talking about that lender, okay? And that lender says you need a 680, but your middle score is a 650. What do? Oh my gosh, oh dear, oh my, I can't get this loan done. Well, not necessarily, okay? Because of your credit score is not quite where they need it to be, talk to your great loan officer, and then you strategize what on that credit report can be fixed or done or paid off to get your score up, right? So a little tidbit I'll let you in on. There are some loan officers, some loan originators and mortgage brokers that will do what's called a rapid rescore. Some of you all have heard about this throughout your home ownership time and home investing. You've heard about the rapid rescore. It is true. It's such a thing called a rapid rescore. Basically, it's a way to reconfigure your credit score for the mortgage lending purposes. But it takes some work. Sometimes you have to pay down a loan a creditor that is on your credit report. Maybe you've got let's say a MasterCard and the balance is $10,000. You might have to pay that down $5,000, or you might have to pay it all the way off, or you just may need to watch your credit utilization. And that's a whole another podcast that we can talk about later on. But your credit utilization, if you're keeping that percent 40% or under, you should be pretty good in getting your credit scores up, right? Your credit utilization is a huge factor when it comes to your credit score. So again, don't be leery, right? If you have a certain credit score and you're that close to getting to the score that you need, okay? Cosigners, okay? We've talked about the FICO scores just now. Let's talk a little bit about cosigning, right? Because again, the topic is, why do lenders say no? Well, sometimes it's as easy as getting a cosigner. Yeah, we do that in the mortgage world. We do. Sometimes we'll get a call from a client. Well, I'm Mary Jane, and my husband, Matt Joe, is not quite qualified to be on this loan with me, right? So I know husband and wives, they're looking to be on the loan together and they're wanting to buy a house together or refinance together. Well, sometimes if Matt Joe isn't qualified, but Mary Jane is, sometimes Mary Jane, you might have to get a co-signer other than Matt Joe, right? Maybe, but Mary Jane may be able to just do the whole thing herself, okay? But in the event that you need a co-signer, think about it. Do you have a child? Yeah, I just closed a loan. That's why I brought up mother and daughter, because I just closed a loan just like that, right? Mother and daughter went on the application together. They both live in the house. Now, there are some cases where you don't have to live in the house and you can still go on the loan with your mom or dad. Yeah, you can. The co-borrower, right, can be a co-borrower who is non-owner occupying, meaning they don't have to live in that property. They don't. And believe it or not, you can possibly get the loan done. So that's when you start, again, strategizing and thinking about other ways of getting your loan done. Now, if this co-borrower that doesn't reside in this property has all their ducks lined up, I'm saying FICO score, I'm saying income. And even if they own another property, right, they can own another property. But again, their debt ratio needs to match or be less than the primary borrower, which is mom or dad or whomever is trying to get the loan, right? You can have a cosigner other than your spouse, So just think about that. You're in a situation where you need just a little bit more income to buy the property you want. You might have to get a cosigner. And then you need to make sure that cosigner qualifies. That's the thing. You don't want to get a cosigner that has $1 bazillion worth of debt and 2 properties and they're still not, their debt ratio is through the roof. That's not your cosigner. But a lot of the times clients get cosigners because of the income factor. So now, here's another question that I get from time to time, and the answer is no. I'm going to say that right now. The answer is no. So let me go ahead and clear up this myth. You cannot use someone's income without their FICO score, without their credit report, without their debt load, right? I get asked that question from time to time. I really do. There's a wife. Oh, I need to go ahead and buy this investment property. Let's get my husband on here. But my husband, he makes $500,000 a year. But for whatever reason, that husband doesn't like to pay bills. So his credit score is under 600. So can we just use his income anyways? Can we just go ahead and use that half a million dollars surely instead of using his credit score? No. The answer is no. If we use their income, their credit is with them. It's a package, right? It's a package. So if you're going to marry the husband, you're going to marry that debt and that income. It comes together. The income comes with the debt. The debt comes with the income. So just keep that in mind. You cannot just use someone's income and not their credit. The credit score comes with them, okay? So just keep that in mind. But I hope, like I said, I know this is a short podcast. We're only on for 30 minutes episode, so that's why you should stay tuned every month. I'm on twice a month. Mortgage Money with Shirley, I'm on twice a month. But these podcasts, I know they're short, but I just wanted to get in here and, like I said, give you just a couple of tidbits that I hope you find educating and useful, okay? So we do take questions and comments and concerns, like I said. And if you have some questions, comments, or concerns, I keep looking at the time because I'm like, I think I'm at my 30 minutes. So if you have some questions, comments, or concerns, feel free. Like I said, you can always call into the studio at area code 323-815-4204, or you can call me direct on my cell phone, area code 818-720-7575. Again, you can always call me, and I'll try to get to your questions, comments, and concerns and give those answers back to you. And guess what? If I don't know the answer, I bet you I'll find the answer. So again, I'm your girl, Shirley Nichols. It's Mortgage Money with Shirley. And again, twice a month. And I try to schedule it sometime at the beginning and the middle of the month, but I always announce it on social media when you'll see these podcasts. But tune into YouTube if you want to catch all the previous episodes. YouTube, Mortgage Money with Shirley. It's right there. Subscribe to the YouTube channel, Mortgage Money with Shirley, and you'll see all the previous episodes. So I hope this has helped you. And if you have any questions or if you need to send this podcast to anyone, just click the share button or tag them in the comment section of Facebook, okay? So thank you so much, and I hope you guys have a great Wednesday and a great rest of your week. Take care.